Hello and welcome. Thank you for joining me on this journey to mortgage freedom. In the next few minutes, we're going to discover how it's possible for you to pay off your mortgage in less than half the time and do so without changing your spending habits. This presentation's for you if you want to own your own home with no mortgage. My name is Bill Neail. I've been a mortgage consultant since 1992. In 1995, my wife Leslie joined me, and since then we've worked together providing our clients with trustworthy counsel and excellent customer. Together, we've helped our clients fund more than 3,500 home loans. Thousands of people know us as the K-Praise Mortgage Answer Team. We've been heard on KPRZ 1210 AM radio since 1995. As you can see by the flashing banner, when people use us as their mortgage lender, they not only save money, they help us save lives too. You see, we use our business to provide the major funding for my ministry as a Christian missionary pilot serving with Mexican medical mission. I also serve as a volunteer medical mission pilot with Angel Flight. Leslie and I are passionate about helping you pay off your mortgage, and that in turn puts the fuel in the airplane so we can be a blessing to others. If you're interested in learning more about our ministry activities, you can find out more by visiting our website and clicking on the Giving Back tab. With that said, let's jump right into how you can pay off your mortgage in half the time or less and do it without changing your spending habits. Let's start by looking at the most popular home financing plan in America. You know, the traditional 30-year fixed-rate mortgage. Let's look at a $100,000 mortgage at a 5.5% interest rate. Over 30 years, you actually pay the bank more in interest than you borrowed. And in the first 10 years, 75 cents of every dollar you pay goes to the bank in the form of interest. You know, the sad truth is that most of us are going to wind up retiring with mortgage debt if we keep doing what we're doing. And the reality is that traditional mortgage solutions don't really work that well for most of us. Let's take a quick look at the options that most people have considered. There's the 10 or 15-year fixed rate mortgage. There's making voluntary payment of extra principal, and the last chance option of a reverse mortgage. The 10 or 15-year mortgage option has several problems that are associated with it. Can you qualify for the large payment? Many people can't meet the lender's income to debt ratio requirement, so this option isn't really available to them. And even if it was, what would happen if you lost your job or experienced a serious health issue or otherwise suffered a loss of income stream? Some clients tell me that they would just refinance to another 30-year mortgage at a lower payment if that happened. But that's not a very good option, because if they were to lose their income, they very likely wouldn't be able to qualify for the refinance. How awful would it be to be stuck with a large mortgage payment and not enough income to cover it? People don't really want to face that, so you know, what they're going to do is they're going to say, I'll just keep my 30-year mortgage and I'll make voluntary principal payments. Well, you know the old saying about good intentions. What I've seen over 20 years experience as a mortgage professional is that life's competing priorities seem to get in the way of doing this. You know, the car breaks down, the children need braces, you know how it goes. So most of us just don't follow through. If you've told yourself that you would make voluntary principal payments on your current mortgage, let me ask you this. How's that been working for you? So that leaves us with the reverse mortgage, and I've helped clients with reverse mortgages, and I can tell you that until you reach about the age of 72, they really don't provide as much help as many people need. And once you take out a reverse mortgage, it immediately begins to erode your estate. And if you care about leaving your children and grandchildren with an estate, this is not a pleasant thought. In order to make headway on our mortgage debt, we need to pay more principal and way less interest. In order to do this, we need to take a fresh look at how interest is calculated. The amount of interest that you pay on a loan is based upon three primary factors: the percentage rate that the lender is charging you, the loan balance upon which the percentage rate applies, and the term or the length of time that you're paying the interest. Banks place the emphasis on the interest rate. You know, you hear the advertisements and read the ads. We've been chasing after lower rates for years because it's an easy way to measure one loan against the other. But principal balance is a very important factor in determining how much interest that you do pay. And the length of time that you pay is also a very important factor in determining how much interest you actually pay. So we see that rate is important, but it's not the only factor that determines how much interest we pay. If we want to pay off our mortgage faster, we need to find a loan that's designed to pay down our principal balance faster than a traditional interest front-loaded mortgage. And that's exactly what we found in the Homeownership Accelerator. Leslie and I are more excited about this innovative home financing plan than any other loan product we've seen in 20 years. With the Homeownership Accelerator, I'll refer to it as the HOA, you can save thousands in interest expense, build equity faster, pay off your loan in half the time or less, and the really fantastic thing is that you can do this with no change to your spending habits. The HOA is an innovative home equity line of credit that also has associated with it what is called a sweep account. You have the ability to write checks from your account, pay bills with auto debits, or online bill pay, just as you would from your checking account. Here's how it works. You replace your current bank-friendly mortgage with the borrower-friendly HOA. Then you deposit your income into your HOA just as you do with your current bank account. You pay your bills and make your after-tax investments out of your HOA just as you do with your current bank account. At the end of the month, you just leave your excess income into your HOA, which reduces your balance. Your funds are always available, so leaving the extra income in your HOA doesn't tie up your money in the event that you needed it for any reason. Your interest expense is reduced because every dollar you deposited into your HOA is applied to principal paydown. This lowers your interest expense because until you need to use your money to pay bills, it sits in your account and reduces the principal balance upon which interest is charged. Rather than sit idle in a bank account, your money is earning you money by eliminating the interest expense on your mortgage. You become the bank of you, and you benefit from the money that otherwise used to sit idle in your bank's hands to lend out to others for their profit. At the end of the month, the interest that you owe on your HOA is calculated based upon looking back over the month at each individual day and calculating the interest owed on each day. The interest expense is automatically added to your HOA principal balance, so you actually don't even have to write a mortgage check. The bottom line here is that with the HOA, you pay a lot more principal and way less interest than you do on a traditional mortgage. And you pay off faster. How much faster? And how much interest do you save with your HOA compared to your traditional bank-friendly mortgage? Answer these questions by taking a look at a typical client that Leslie and I might see taking advantage of the HOA. Here's their situation. One of them receives a paycheck twice a month and takes home, after withholding, $2,500 each check. The other takes home $2,100 once each month. They anticipate that their income is going to increase 2% a year as they progress along in their jobs. They have excellent credit and they own a $400,000 house that has a 30-year mortgage on it at 5.5%. They've been paying on it for a couple years now. Their current mortgage balance is a little over $290,000. Now here's what they do. They replace their mortgage with the HOA and start depositing their income into their HOA instead of where they used to at their bank. During the month, they pay various bills and living expenses out of their HOA when they are due by using the electronic funds transfer and auto debit features of the account. By the end of the month, they have withdrawn 90% of their deposits for these living expenses, leaving 10% of their deposits in their HOA. Remember, this 10% is still available to them if they really needed it, but they don't, and so they choose to leave it in their HOA to reduce the balance. So, how does their HOA compare with their old 30-year mortgage? The final result depends upon assumptions that we have to make regarding the interest rate that will apply to the HOA. The HOA is an innovative home equity line of credit designed specifically to help you pay less interest and pay off your home loan much faster. Similar to other home equity lines, the rate is based upon an index plus a margin. The index used in the HOA is the popular one-month LIBOR index. LIBOR is an acronym. It stands for London Interbank Offered Rate. Looking back in time over the past 20 years, we can see that the average LIBOR rate has been about 7% when the typical HOA margin of 2.85 is added. You can see in this graph that there were 3 periods of times that interest rates increased over the last 20 years, and when they did, they increased at about an average of 1.4% each year. So, looking into the future, we need to make some kind of reasonable assumption about what will happen with interest rates. Will they stay at the same very low rates that they are today? Some experts believe that they will for a couple of years before they increase, but I'm sure we'll all agree that eventually rates will go up. So I'd like to start my analysis by looking at what's the worst possible case that could happen. So the first scenario we'll look at is the worst possible case. We'll assume that rates increase at the 1.4% annual rate immediately until they reach the maximum rate possible under the terms of the HOA, which is 6% above our example client's starting rate calculation. After reaching the worst case possible, we'll then assume that rates drop once again at 1.4% a year until they reach the historical average of 7%. Then we'll assume that the rates are never lower than 7%. After looking at the sky is falling worst case possibility, we'll look at what would happen if rates just immediately increased at 1.4% a year until they reach the historical average of 7% and they never ever come down. And finally, we'll look at what would happen if rates did stay at their current low rates, which you and I know is not likely. But the reason we'll present this is so you can see the impact of rising rates on the HOA's performance. In the worst case assumption that's possible, our clients are going to pay off their HOA in 14.8 years. If rates were to increase immediately and stay at their historical average of 7%, never coming back down from there, our clients pay off their HOA and enjoy mortgage freedom in just 13.4 years. And if rates remained at their current low 3.5% rate, they'd pay off their HOA in only 11.2 years. So in review, we see that even in the worst possible case assumption for rising rates, our clients pay off much faster and save thousands of dollars in interest expense. They pay off in 14.8 years compared with 28 years. They pay $188,000 in mortgage interest compared to $250,000 in mortgage interest. Now, while these results are impressive and the facts speak for themselves, some of our clients still struggle with the concept of an adjustable rate mortgage. And this is understandable, of course, because it's only natural to be apprehensive about the unknown. Now, the key to understanding how to overcome this concern is that rate is only one of 3 aspects determining how much interest you pay. That's why I start all my calculations using the worst case possible scenario when we determine how much the HOA would benefit our clients. If we see excellent results as we did with this example, we know that there's no reason to worry about rising interest rates. And if we look at the results using the rate scenario where rates rise immediately and stay at the 7% historical average, our example clients pay off their mortgage in less than half the time, and they did it without changing their spending habits. So now, go right back to your situation. How soon can you get your mortgage off of your back and start enjoying mortgage freedom in your personal circumstances? The answer can be found when we run your individual HOA simulator and examine the results for your unique set of circumstances. All it takes is a friendly 20-minute chat, and there's no cost, there's no obligation, and we can do this right over the phone using my GoToMeeting web-based conferencing. What have you got to lose? Except years off of your mortgage. Give us a call. We also invite you to go to our website where you'll find additional information and video testimonies from others who have joined the mortgage revolution and are on their way to enjoying mortgage freedom. I'm sure you'll enjoy the conversation. It'll be very interesting, and Leslie and I look forward personally to speaking with you. Have a great day.